When people think about control over the world's oil routes, they usually imagine naval fleets, military patrols, or the closure of strategic waterways. But in reality, another system often determines whether oil can move across the world's oceans. Insurance. A recent development in the Persian Gulf shows how this system works in practice. The London marine insurance market has expanded the official higher-risk maritime zone, covering large parts of the Persian Gulf. The decision was taken by the Joint War Committee, which monitors global maritime security risks for insurers. This move comes after a series of attacks on commercial shipping in the region. When an area is designated as a war risk zone, ships entering it must purchase additional war risk insurance coverage. And those premiums can rise sharply. Marine insurance is not just a financial detail. It is a basic requirement for global shipping. Without valid insurance, ships cannot enter most international ports. Banks will not finance cargo shipments. Charter companies will not hire vessels. In practice, this means insurance markets can determine whether a shipping route is economically viable. When war risk zones expand, the cost of insurance can increase dramatically. For a large oil tanker, a war risk premium can jump from tens of thousands of dollars to hundreds of thousands, sometimes even more than $1 million for a single voyage. Those costs are eventually reflected in shipping rates and, ultimately, in energy prices. The Persian Gulf connects directly to the Strait of Hormuz, one of the most critical energy choke points in the world. Roughly 1/5 of global oil trade passes through this narrow corridor every day. That means even small changes in the risk environment can ripple through global energy logistics. Importantly, this can happen without any physical blockade. The route remains open, but it becomes more expensive and more dangerous to use. Military blockades are visible and immediate. Insurance decisions are quieter, yet the impact can be similar. If risk premiums rise high enough, some shipping companies simply avoid the area. Fewer ships enter the region. Tanker availability drops, and transportation costs increase. This is why maritime insurance functions as a hidden control system in global trade, not through military force, but through the pricing of risk. And when insurers in London redraw the boundaries of a war risk zone, the effects can be felt across global energy markets.